Before we dive in, please remember that I am not a financial advisor, and this video is for educational and entertainment purposes only. The world of cryptocurrency is extremely volatile, and you should always conduct your own thorough research and consult with a certified financial professional before making any investment decisions. All strategies and investments involve risk of loss. Your capital is at risk. Okay, now that the lawyers are happy, let's talk about the biggest lie in crypto. You've seen it. Bright green letters on a slick, minimalist app, screaming at you. Trade crypto with zero fees. You feel like you found a cheat code, a way to beat the system. You make a trade, you put in $1,000 to buy some Ethereum. The price looks about right, you swipe up, the confetti animation explodes on your screen, and you feel like a genius. But then, a few hours later, you check your portfolio. The price of Ethereum hasn't really moved, but your $1,000 is now worth $975. You blink. You check the trade confirmation. It says it right there. Commission $0. So, where did your $25 go? You're not crazy. You didn't imagine it. Your money vanished into thin air. And in this video, I'm going to show you exactly how they did it. This isn't about just one company. This is about a business model. A financial sleight of hand perfected in the US stock market, and now weaponized in the unregulated Wild West of crypto. We are going to pull back the curtain on the so-called zero-fee exchanges. I'm not just going to tell you they have hidden fees. I'm going to show you the 3 specific mechanisms they use to take your money without ever sending you a bill. First, we'll dissect the biggest and most deceptive charge of all, the bid-ask spread. Then we'll journey into the murky, controversial world of payment for order flow. And finally, we'll expose the gotcha fees that trap your money on their platform. By the end of this video, you will be a human lie detector for crypto marketing. You will not only be able to spot these hidden costs from a mile away, but you'll also have a clear framework for deciding which type of exchange is actually the cheapest for you for your goals right here in the United States. I've spent hundreds of hours digging through the fine print, comparing real-time trade data, and reverse engineering these platforms so that you don't have to get burned like I did. The Wall Street pros know these tricks. It's time we did too. Let's start with the #1 profit engine for these platforms: the spread. The bid-ask spread. It sounds like Wall Street jargon, but the concept is dead simple. Imagine you're at an airport currency exchange booth. On the screen you see 2 prices for the euro. We buy at $1.05 and we sell at $1.15. The actual real market rate for a euro might be $1.10, but the booth doesn't offer you that price. They buy it from you at a discount and sell it to you at a premium. The 10-cent difference between their buy price and their sell price is the spread. That's their profit. It's how they keep the lights on without charging you a service fee. Now, apply that exact same logic to crypto. On a professional exchange, a platform built for serious traders, the market is made up of millions of real buyers and sellers. The spread is determined by natural supply and demand, and it's usually razor thin. For something like Bitcoin, the difference between the highest price someone is willing to pay, the bid, and the lowest price someone is willing to sell for, the ask, might be just a few dollars or even cents. It's an efficient, transparent marketplace. But a zero-fee app is not a marketplace. It's a store. It is the airport currency exchange booth. They are not connecting you with another person to trade. Instead, they, or a partner company, are the ones selling you the crypto directly. And just like that airport booth, they create their own spread. And it is not razor thin. It is wide. It is fat. And it is designed to extract maximum value from you on every single transaction. Let me give you a concrete example. Let's say the true, global market price of 1 Bitcoin right now is exactly $50,000. You could see this price on a data source like TradingView or CoinMarketCap. You open up your slick zero-fee app. You go to the Bitcoin page and you see a big button that says buy. But the price you see next to it isn't $50,000. It's $50,200. That's their ask price. Then out of curiosity you tap the sell button. The price instantly changes. They're not offering to buy it back from you at $50,000. They're offering to buy it at $49,800. That's their bid price. Do you see what just happened? The real market spread might have been $1 or $2. But on this app, the spread is $400. That $400 is their hidden fee. It's their profit margin. They're buying Bitcoin on the open market for around $50,000 and then turning around and selling it to you, their retail customer, for $50,200. They charge you a 0.4% premium with no commission and call it free. You might think, okay, 0.4% doesn't sound that bad. But let's do the math and compare it to the alternative. Let's say you want to invest $1,000. On the Zero Fee app, your $1,000 buys you Bitcoin at their inflated price of $50,200. You get 0.01992 Bitcoin. Now, let's say you used a professional style exchange that charges a transparent fee, say 0.1%. You'd buy your Bitcoin at the real market price of $50,000. Your $1,000 would first have the $1 fee deducted, 0.1% of $1,000, leaving you with $999 to invest. At the real market price, that $999 gets you 0.01998 Bitcoin. Look at those two numbers. On the free platform, you got 0.01992 Bitcoin. On the platform that charged you a fee, you got 0.01998 Bitcoin. You ended up with more Bitcoin by paying a fee. The free trade actually cost you 4 times more. The difference seems tiny, but this scales up with every dollar you invest and every trade you make. Over a year of active trading, this is the difference between a profitable strategy and a losing one. But the real psychological damage of the spread is even worse. The very instant you click buy on that Zero Fee app, you are already underwater. You bought at $50,200. To simply break even, the entire global market for Bitcoin has to rise by $200 just to catch up to the inflated price you were charged. And if you needed to sell immediately for an emergency, you'd have to sell at their lowball offer of $49,800. You would instantly lose $400 per Bitcoin, a loss of 0.8%, before the market even moved a single penny against you. This business model is predatory because it specifically targets newcomers. It preys on people who are attracted to the simplicity and the magic word free. Experienced traders know to check multiple price sources and understand the concept of a spread. But if you're just starting out, you trust the number you see on the screen. You trust that zero fees means zero cost. It's a deliberate and highly profitable deception. This model was born in the US stock trading world with apps that gamified investing, and it has found its perfect home in crypto, an asset class that is already complex and intimidating to beginners, and where regulatory oversight is still catching up. They've turned a bug, a lack of understanding, into a feature of their business. The spread is the silent portfolio killer, and it's just the first layer of the zero fee onion. The next layer is even more insidious because it involves what they do with your trade before it ever even happens. It's a practice that was dragged, kicking and screaming, into the light in the stock market, and it has found a shadowy, unregulated home in crypto. It's called payment for order flow, PFOF, and it's the reason your free trade isn't free at all. In fact, you aren't the customer. You are the product being sold. Imagine you want to buy a concert ticket online. The listed price is exactly $100. You go to a zero-fee ticket broker to place your order. You click buy. Now, in a fair world, that broker would instantly go to the main ticket office and secure your $100 ticket for you. But that's not what happens. Instead, this zero-fee broker has a secret backroom deal. They don't send your order to the ticket office. They send it to a huge professional ticket scalper. They tell the scalper, "Hey, we've got a guy here who is ready to buy a ticket for $100. The scalper pays your broker a small fee for this inside information. Then, armed with the knowledge that your purchase is coming, the scalper, with their super-fast computers, zips to the front of the line, buys the ticket for $99.95, and then immediately sells it to you for the $100 you were willing to pay anyway. You got your ticket for the price you expected. The broker got a kickback from the scalper, and the scalper made a risk-free 5 cents. Everyone seems to win, right? Except that 5 cents was rightfully yours. There was a better price available on the market, but you were never shown it. Your broker had no incentive to find it for you. Their incentive was to route your order to the scalper who paid them the most. Now, multiply that 5 cents by millions of orders every single day. It's not pennies. It's a multi-billion-dollar industry, built on harvesting fractions of a cent from your transactions. This is payment for order flow, and it's happening right now with your crypto trades. When you press buy on that shiny, user-friendly zero-commission app, your order doesn't necessarily go to a public exchange like Binance or Kraken. Instead, the app, your broker, bundles your order up with thousands of others and sells this bundle of order flow to a third party. These third parties are not your friendly neighborhood crypto enthusiasts. They are massive, sophisticated quantitative trading firms, often called market makers or high-frequency traders. Think Citadel Securities, Virtu Financial, Jump Trading. These are the apex predators of the financial world. They pay your broker billions of dollars a year for one simple privilege: the right to see your order before anyone else and to trade against it. They get a sneak peek at what millions of retail investors are buying and selling. This information is pure gold. It allows them to engage in what is essentially a legalized form of front-running. They see your buy order for one Bitcoin at $50,000 coming down the pipe. Their algorithm can instantly scan the entire market, find that Bitcoin for $49,999, snatch it up, and then complete your order by selling it to you for the $50,000 you requested. They pocket the $1 difference, a dollar you never even knew you lost. The exchange, your trusted zero-fee platform, got paid by the high-frequency trader for handing you over on a silver platter. The only person in this entire chain of events who didn't make money is you. You were simply the fuel for their profit engine. Now, defenders of this practice will hit you with a lot of jargon. They'll say it provides liquidity to the market and leads to price improvement. Let's dismantle that. Price improvement is the idea that sometimes the market maker might give you a slightly better price than you asked for. Maybe they fill your $50,000 order at $49,999.90, giving you a 10-cent improvement. They then use this as a marketing tool, claiming they saved investors money. But it's a smokescreen. The data shows that the tiny token price improvements they offer are dwarfed by the profits they're making on the whole arrangement. It's like a mugger stealing your wallet with $100 in it, but then graciously handing you $1 back and calling it a rebate. The bigger issue here is a fundamental conflict of interest. In the traditional stock market, brokers have a legal and ethical obligation known as best execution. This means they are required to get the best possible price for their clients. But how can an exchange truly be committed to getting you the best price when another company is paying them to send your orders their way? Their loyalty is divided. Their real customer isn't you, the person using the app. It's the high-frequency trading firm that's paying their bills. You are just the raw material they process. This creates a dangerous two-tiered market. There's the smart money, the high-frequency firms who see the entire board. And then there's the dumb money. That's us, the retail traders, whose collective actions are sold to the highest bidder. We're playing checkers while they're playing 4D chess on a supercomputer, using our own moves against us. And in the world of crypto, this problem is on steroids. The crypto market is the Wild West. The regulations around best execution that exist in the stock market are either completely absent or toothless in crypto. There's no sheriff in town. A crypto exchange can route your order wherever it wants with far less oversight. They don't have to disclose nearly as much about their PFOF arrangements. The backroom deals are shadier, and the data is murkier. Furthermore, the crypto market is incredibly fragmented. Unlike the stock market, where the New York Stock Exchange or NASDAQ are the main arenas, crypto trades happen across hundreds of different exchanges, liquidity pools, and decentralized platforms, all with slightly different prices at any given millisecond. This fragmentation is a paradise for PFOF schemes. A broker can easily claim they got you a good price from their partner market maker, but it's nearly impossible for you, the individual, to verify if it was the absolute best price available across the entire chaotic crypto ecosystem at that exact moment. They are exploiting the complexity and opacity of the market, and they're doing it at your expense. So let's recap the scam so far. First, they get you with the spread. They build a hidden fee into the price itself, making you pay more than you should. That's layer 1. Then, before your trade even executes, they sell your order to a high-frequency trading firm who can legally front-run you, scraping another fraction of a penny off your trade. That's layer 2. You're being hit from 2 different directions before you even own the asset. You might be thinking, okay, this is bad. They're skimming a bit off the top and a bit off the side. But at the end of the day, I click buy, and the crypto appears in my account. At least I own it, right? And that is the most dangerous assumption of all. Because the third layer of this onion is the most unsettling. It's a secret that underpins the entire business model of many of these exchanges. It's about what happens after your trade is complete. It's about the digital wallet where your assets are held. And the truth is, the Bitcoin you think is sitting safely in your account might not be there at all. In fact, you may not own it in any meaningful way. You might just own an IOU from a company that is using your assets for its own high-stakes gambles. Let's unpack that bombshell. An IOU. It sounds simple, almost harmless, like a note scribbled on a napkin between friends. But in the world of high finance and digital assets, an IOU is a chasm of difference. It's the difference between holding a bar of gold in your hand and holding a piece of paper that says a bank somewhere owes you a bar of gold. With the physical gold bar, you have absolute control. You can store it, move it, sell it to whomever you want, whenever you want. It is yours. But with the piece of paper, you own a promise. You have a contractual right, a claim on a gold bar. You are now a creditor, and the bank is your debtor. You're trusting that when you come to collect, they haven't lost it, lent it out to someone who can't pay it back, or used it as collateral for a risky bet that went south. This is precisely the model most zero-fee crypto platforms in the United States operate on. When you click buy on their slick, user-friendly app, you are not actually executing a transaction on the blockchain to acquire a specific, identifiable piece of digital property. You are handing your US dollars over to the company, and in return their internal ledger, their private spreadsheet gets updated. A number next to your name goes up. You see 1 Bitcoin in your account, and you feel the psychological rush of ownership. But what you really have is a beautifully designed IOU. The company has your money, and you have their promise to give you back that value in crypto or dollars when you ask for it. So where is the actual Bitcoin? It's not in a little digital wallet with your name on it. Instead, it's pooled together with the crypto of millions of other users into a few colossal accounts controlled by the exchange. These are called omnibus accounts. Think of it like a giant grain silo. 1 million farmers deposit their wheat, and all you know is that you're owed 1,000 bushels. You have no claim to any specific grains of wheat, you just have a claim on the silo as a whole. This system is efficient for the company. It makes trading fast and cheap, since most trades are just numbers changing on their internal spreadsheet, not slow, expensive transactions on the actual blockchain. But it also gives the company an incredible amount of power over a massive multi-billion-dollar pool of assets. Your assets. And this is where we have to pull out the magnifying glass and read the one thing nobody ever reads: the terms of service. Buried deep in the legal jargon of these user agreements, often dozens of pages long, are the clauses that turn your ownership into an illusion. You'll find phrases that give the platform the right to lend, pledge, rehypothecate, or otherwise use the crypto assets held in your account. Let's break down that scary-sounding word, rehypothecation. It's a fancy term for a simple and terrifying concept. It means they can take an asset that you own or think you own that you've pledged to them as collateral, and they can turn around and use it as their own collateral for their own loans and their own trades. Let's use a more concrete example. Imagine you have a classic, pristine 1967 Ford Mustang. You don't have a garage, so you pay a specialty storage facility to keep it safe. You give them the keys and they give you a claim ticket. You expect them to just park it in a secure, climate-controlled room. But in the fine print of your storage agreement, it says they have the right to utilize your car. One night you're out to dinner and you see your Mustang, your car, pull up to the curb working as an Uber. The storage company is renting it out, collecting the fares. The next weekend, you hear they've entered it into a local street race, trying to win a cash prize. They are taking your priceless asset, putting it at risk, subjecting it to wear and tear, and they are collecting all the profits from these activities. You, the actual owner, get nothing but the risk. If the driver they hired crashes it, or if the engine blows during the race, they might just shrug and say, "Sorry, market conditions." They might not have the money to make you whole. That is rehypothecation. And that is what these zero-fee exchanges are legally empowered to do with your crypto. They are not just storing your Bitcoin. They are putting it to work in the highly volatile, largely unregulated world of crypto finance. They lend it out to hedge funds and large institutional traders who are making massive leveraged bets. These borrowers pay the exchange a high interest rate for the loan, which becomes a huge revenue stream for the exchange. You see none of this profit, of course, but you are unknowingly underwriting the entire risk. If the hedge fund they lent your crypto to makes a bad bet and gets liquidated, which happens all the time in crypto, it can't pay back the loan. The exchange is now out a huge chunk of crypto. And since it was all pooled together in that giant omnibus account, it wasn't their crypto they lost. It was everyone's. It was yours. This creates a terrifying chain of risk, a contagion effect. The exchange lends your Bitcoin to firm A. Firm A lends that same Bitcoin to firm B to earn a little extra yield. Firm B uses it as collateral for a risky trade. If that trade goes wrong, firm B defaults. Firm A is now in trouble because it can't get its crypto back from firm B, so it can't pay back the original exchange. And now the exchange, the one you trusted, has a massive hole in its balance sheet. When you go to their app and hit sell, you expect it to work instantly. But what if thousands of people do it at the same time during a market panic? The exchange has to go out and get that crypto back from all the places they've lent it to. It's a frantic scramble. And if they can't get it back fast enough or at all, they do the one thing they can. They halt withdrawals. They freeze your account. Suddenly, your IOU is worthless. Your claim ticket is for a car that has already been crashed and sold for scrap. We saw this exact scenario play out with companies like Celsius, Voyager, and BlockFi. Millions of users believed they owned their crypto, that it was sitting safely in a digital vault. They were lured in by promises of high-yield earn accounts, which were just a more explicit version of this same business model. They were, in reality, unsecured creditors to a wildly irresponsible, unregulated shadow bank. And when the music stopped, they lost everything. The zero-fee exchanges you use every day are, in many cases, just a more subtle mainstream version of this same game. They aren't promising you 18% yield, but they are using the same mechanics behind the scenes. They are using the massive pool of customer assets, your assets, as their own private piggy bank to gamble on the crypto markets. All to support an illusion, the illusion that you can trade one of the most volatile asset classes in the world for free. Nothing is free. The question you have to ask is, what is the real price you're paying? You think you're saving a few dollars on a trading fee, but the invisible price you're paying is risk. A catastrophic, platform collapsing level of risk that you have been opted into without your explicit, informed consent. So if they're taking all this risk with your crypto, it must be for a good reason, right? It must be a central part of their business model. And it is. This lending and gambling isn't just a side hustle for them. It's a critical pillar of how they can afford to dangle the zero-fee carrot in front of you. But it's only one pillar. The other, the one you interact with every single time you press that buy or sell button, is even more subtle, and it may be costing you far more than you could ever imagine. It's a hidden tax embedded in the very price of the crypto you're buying. It's called the spread, and if you've ever exchanged currency at an airport, you've already been a victim of it. Think about it. You're heading to Europe, you walk up to the currency exchange booth. The big board says the official exchange rate is $1.10 for €1. But when you hand the teller $100, you don't get 91 euros back. You get maybe 88. And when you come back from your trip with leftover euros, they don't give you $1.10 for each one. They give you $1.05. They didn't charge you a fee, did they? No, the sign probably said, "Zero commission." But they made money on both sides of your transaction. The difference between the price they were willing to buy at and the price they were willing to sell at, that gap, that chasm, is the spread. It's their profit. It's their entire business model. Now take that airport currency booth, digitize it, wrap it in a slick, easy-to-use app, and you have a zero-fee crypto exchange. They are the house, and the spread is their built-in, non-negotiable, and almost invisible advantage. So how does this actually work on the screen in front of you? Every asset in the world, from stocks to gold to Bitcoin, has two prices at any given moment. There's the bid price, which is the highest price a buyer is currently willing to pay. And there's the ask price, which is the lowest price a seller is willing to accept. On a professional trading platform, you can see both of these prices. You can see the order book, the living list of all the bids and all the asks. The difference between the highest bid and the lowest ask is the natural market spread. And for a liquid asset like Bitcoin, it's usually razor thin. We're talking fractions of a penny. But on your simple zero-fee app, you don't see any of that. You don't see the order book. You don't see the true market. You see one price. The price they are offering you. Let's put some real numbers on this. Let's say the actual global market price of Bitcoin at this very second is $60,000. On a professional exchange, the highest bid might be $59,999. The lowest ask might be $60,001. A tiny $2 spread. You open your zero-fee app. You want to buy $1,000 worth of Bitcoin. The app says, "Great. The price is $60,300. You press buy. The transaction goes through. You feel good. Zero fees. But wait, the real market price was $60,000. You paid $60,300. That $300 difference, that's not the market. That's the house. That's the app spread. On your $1,000 purchase, you didn't get $1,000 worth of Bitcoin at the real market price. You got about $995 worth. You instantly lost $5. Not to market volatility. You lost it to the platform. Now let's say the price of Bitcoin goes up to $61,000. You're excited. You decide to sell your holdings to lock in the profit. You open the same app. The real market price is $61,000. But the app doesn't offer you that. The app says, "We will buy your Bitcoin for $60,700. Again, a $300 difference from the real price. You press sell. You think you made a profit, but you paid a premium to get in and you took a discount to get out. That spread cost you on the way in and it cost you on the way out. Let's do the math. A $300 spread on a $60,000 asset is a 0.5% fee. So you paid a 0.5% fee to buy and a 0.5% fee to sell. Your total, round-trip transaction cost was 1. All on a platform that proudly advertises zero fees. You see the genius of it? It's a financial sleight of hand. If that app had a banner that said, "We charge a 1% fee on all trades," many people would hesitate. They'd shop around. But by calling it zero fee and just manipulating the price they show you, they achieve the same result, with far less customer resistance. They're not charging you a fee. They're just selling you an overpriced asset and buying it back from you at a discount. It's a hidden tax on every single click of the buy or sell button. You might be thinking, okay, 0.5%, that doesn't sound catastrophic. But let's scale it up. Let's say you're more active. You make 10 trades a year, investing a couple $1,000s each time. That 1% round-trip cost starts to add up. It's hundreds of dollars vaporized from your account, not because your investment choices were bad, but because the platform was designed to shave a little off the top every single time. It's an invisible parasite on your portfolio, constantly draining its potential. This is why so many new traders feel like they're running in place. They make a good call, the price goes up 2%, they sell, but after the spread, they've only actually made 1%. Or worse, the price moves 1% in their favor, they sell, and they actually lose money. They chalk it up to bad luck or volatility, never realizing the game was rigged against them from the start by the very platform they trusted. And the more volatile or less popular the crypto, the worse it gets. For major coins like Bitcoin or Ethereum, the spread might be manageable, maybe 0.5% to 1.5%. But for that hot new altcoin everyone's talking about, the platform knows there's a frenzy. They know you're not price checking. They can widen that spread to 3, 4, even 5%. You could lose 10% of your investment on a single round-trip trade before the market even moves a single inch. This is the fundamental business model. It preys on a simple, powerful psychological bias. We hate obvious fees, but we are terrible at noticing subtle costs. We'll drive across town to save 50 cents on a gallon of gas, but we won't spend 2 minutes to check if the price of the asset we're about to buy is fair. The zero-fee platforms know this. They built their billion-dollar empires on it. So you're paying for the convenience. You're paying for the simple interface. But the price you're paying is hidden, and it's almost certainly far higher than the transparent, upfront fees charged by more professional exchanges. This begs the most important question of all. How can you even know what the real price is? If the app is showing you a manufactured price, where do you look to find the truth? How do you pull back the curtain and see the actual market that the big players are trading on? The answer lies in understanding the engine room of the entire crypto market, a place your zero-fee app desperately hopes you never learn about. It's a world of order books, liquidity pools, and market makers. And understanding how that world works is the only way to protect yourself from these hidden fees and finally start trading on a level playing field. It's the difference between being the tourist at the airport booth and being the bank. So let's step behind the counter and become the bank. Imagine the entire crypto market is a giant, chaotic bazaar. Thousands of people are all trying to buy and sell Bitcoin at the same time. One person is shouting they'll sell for $60,010. Another is screaming they'll only buy for $59,990. It's noisy, it's inefficient, and finding someone who agrees on the exact same price at the exact same moment you want to trade is nearly impossible. If you want to sell your one Bitcoin, you'd have to wander through this chaotic bazaar, find the person willing to pay the highest price, and hope they're still there by the time you reach them. This is a market with no liquidity. It's slow, it's clunky, and prices are all over the place. Now, into this chaos steps a special kind of vendor, the market maker. Think of them as the ultimate pawn shop owner, but for trillions of dollars in assets. They set up a huge, well-lit stall right in the middle of the bazaar. On one side of their stall, they put up a big sign that says, "We are always buying Bitcoin." This is their bid price. Let's say it's $59,995. On the other side of the stall, they put up another sign. "We are always selling Bitcoin." This is their ask price. Let's say it's $60,005. Notice the difference. They buy for a little less and sell for a little more. That $10 gap between the bid and the ask is called the spread. And that spread, that is their entire business model. It's their profit. They don't care if Bitcoin goes to the moon or to zero. Their job isn't to predict the future. Their job is to be the constant, reliable presence in the market, always willing to take the other side of your trade. You want to sell instantly? Fine. They'll buy it from you at their bid price. You want to buy instantly? Great. They'll sell it to you from their own inventory at their ask price. They are the grease in the gears of the financial world. By always being there, they create liquidity. They turn that chaotic bazaar into a smooth, efficient supermarket where you can instantly buy or sell at a known price. And for providing this incredibly valuable service, they skim a tiny, tiny fraction off the top of every single transaction. A few dollars here, a few cents there. It doesn't sound like much, until you realize they are doing this millions of times per second across thousands of different assets. They are the house, and the spread is their permanent built-in edge. Okay, so what on earth does this have to do with your zero-fee crypto app? Everything. This is the absolute core of the secret. When you log into your shiny, user-friendly app and hit the buy button for $100 worth of Ethereum, you probably imagine your order zipping off to a big, public exchange like the New York Stock Exchange or NASDAQ, where it competes with all other orders to find the best possible price for you. That is not what happens. Not even close. Instead, your broker, the zero-fee app, doesn't send your order to the public market at all. They bundle it up with thousands of other small orders from people just like you, and they sell that entire bundle directly to one of those giant market makers. This practice has a name, and it's a phrase you need to burn into your memory. Payment for order flow. PFOF. Payment for order flow. Let that sink in. Your broker is being paid to route your order to a specific destination. The market maker is literally paying your broker for the privilege of handling your trade. Why would they do that? Why would a massive Wall Street firm pay for your tiny $100 crypto order? Because they know you are what they call uninformed flow. That doesn't mean you're stupid. It's a technical term. It means you're not a high-frequency trading firm with a supercomputer trying to sniff out tiny market inefficiencies. You're just a regular person buying some crypto. You are predictable. And because you are predictable, you are profitable. The market maker who buys your order knows they can fill it at their ask price, capture that bid-ask spread, and make a guaranteed risk-free profit. They take the $10 spread on your Bitcoin trade, and maybe they kick back $1 of that profit to the zero-fee app as a thank you. That $1 is the payment for order flow. That is how your broker makes money. They are not a charity. They are not your friend. They are a business and their product is you. Your trade is the commodity they are selling to the highest bidder. This creates a spectacular conflict of interest. Your broker has a legal obligation to get you the best execution possible on your trade. But how do you define best? Is it the absolute rock-bottom best price available across the entire universe of buyers and sellers at that exact millisecond? Or is it a price that's just pretty good? The market maker who paid for your order doesn't have to compete. They don't have to give you the best price in the world. They just have to give you a price that isn't ridiculously bad. They might fill your order to buy Bitcoin at $60,005, capturing their $10 spread. But maybe, at that exact same moment on a different public exchange, someone was willing to sell for $60,001. By having your order routed privately to a paid partner, you just lost $4. You overpaid. You never saw the better price because your broker never showed it to you. Their financial incentive is not aligned with yours. Their incentive is to route your order to whichever market maker pays them the most money in kickbacks. Think back to our airport currency exchange. Payment for order flow is like the taxi driver getting a kickback for taking you to the exchange with the worst rates. The taxi driver tells you it's a free ride, but he's not taking you to the best destination. He's taking you to the one that secretly pays him. You end up paying for that free ride through terrible exchange rates, and you might not even realize it. This is the fundamental illusion of zero fee. You're not paying a $5 commission that you can see. Instead, you're potentially losing $6, $7, or even $15 on the price of the asset itself, a fee that is completely invisible. It's buried inside the price you paid. It's a phantom fee, deducted from your account without ever appearing on a statement. You might buy a stock for $50.10 when you could have gotten it for $50.04. That 6-cent difference is your real fee. Doesn't sound like much, but multiply that by thousands of trades across millions of users, and you are looking at one of the biggest and most profitable revenue streams in modern finance. It is a machine designed to extract billions of dollars, pennies at a time, from the pockets of everyday investors. And the most brilliant part is they convinced everyone it was free. They hid the fee in plain sight, right in the price you were quoted, and then built a multi-billion-dollar empire on the fact that most people would never bother to look. But now you know where to look. And the question becomes, how much is this invisible system actually costing you? How do we calculate the true price of free? To calculate the true price of free, you first have to understand that you're not paying with money. You're paying with information. You're paying with priority. You're paying with the price itself. This isn't a simple transaction fee you can see on a receipt. It's a death by 1,000 cuts, woven into the very fabric of the trade. The cost is the difference between the price you could have gotten in a fair market and the price they chose to give you. Let's start with the biggest offender, the one that accounts for the vast majority of these hidden costs. The spread. The bid-ask spread. You've probably heard the term, but most people treat it like background noise. In the world of free crypto, it's the main event. Think of it like a currency exchange booth at the airport. They have a buy price for dollars and a sell price for dollars. And those two prices are never the same. The difference between them? That's their profit. That's how they keep the lights on without charging a fee. Zero-fee crypto platforms have turned this concept into an art form. On a professional exchange, the spread for a major asset like Bitcoin might be razor-thin, a few dollars, maybe even cents, because thousands of buyers and sellers are competing in real time, forcing the price to its truest point. But on a free app, there is no open competition. There is only you and the house. They are the market maker. They set the buy price and they set the sell price. And they can make that gap, that spread, as wide as they think they can get away with. So let's put some real numbers on this. Let's say the true global market price for one Bitcoin, the price you'd see on a Bloomberg terminal, is exactly $50,000. You go to your slick zero-fee app to buy one. The app doesn't show you the $50,000 price. Instead, it shows you a buy price of $50,250. And if you wanted to sell, it would show you a sell price of $49,750. See what happened? The spread isn't a few dollars. It's $500. When you hit buy, you instantly pay a $250 premium over the real market price. If you were to turn around and sell it 1 second later, you'd instantly lose $500. You paid no fee, but you just paid a 0.5% tax to the platform. On a $50,000 transaction, that's $250. Now let's compare that to a traditional exchange that's transparent about its costs. They might charge a 0.1% taker fee. On that same $50,000 purchase, your fee would be a clear upfront $50. You would be saving $200 by choosing the platform that charges a fee. The free option was 5 times more expensive. This is the fundamental illusion. They've taken the fee, which used to be a line item, and baked it directly into the price of the asset. It feels better psychologically because you don't see the fee being deducted. You just see the price you pay. It's a brilliant, predatory design that preys on our innate desire to avoid explicit costs, even if it means paying far more in implicit ones. But the spread is just the beginning. It's the most obvious part of the invisible machine. The next layer is something even more insidious, a concept borrowed from the controversial world of stock trading. Payment for order flow, or PFOF. This is where it gets dark. When you place an order on one of these free platforms, you probably assume your order goes straight to an open market to be filled at the best possible price. That is a dangerously naive assumption. In many cases, the platform doesn't execute your order at all. Instead, they sell it. They sell your intention to buy or sell to a third party, usually a massive high-frequency trading firm or a hedge fund, also known as a wholesale market maker. These firms pay the free app billions of dollars a year for the privilege of executing your trades. Why? Why would they pay for your small order? Because they are buying information. They get to see your order before the rest of the market does. And in a game of milliseconds, seeing the future, even a millisecond into the future, is the ultimate advantage. These high-frequency firms can then fill your order from their own inventory, at a price that is beneficial to them, not you. They might see your buy order for Ethereum at $2,000, and instead of finding you the best price, they can legally front-run your order, buy up the cheaper ETH themselves, and then sell it to you at your $2,000 limit, pocketing the difference. The free app gets paid by the trading firm profits from giving you a slightly worse price, and you, the customer, are the product that was just bought and sold. You got your free trade, but you were the last one to eat at the table, and you were served the scraps. This is the dirty secret of Silicon Valley's fintech revolution. It's not about democratizing finance. It's about packaging retail investors into a product and selling them to Wall Street. And this leads to the third hidden cost, slippage. Slippage is the difference between the price you clicked and the price you actually got. You tap buy when Bitcoin is at 50,000, but by the time the order actually executes through this convoluted PFOF system, the price is $50,050. That $50 difference is slippage. While some slippage is normal in a fast-moving market, systems that rely on PFOF are notorious for having worse slippage for retail users. Why? Because the incentive isn't to execute your trade as fast as possible at the best price. The incentive is to route it in the way that makes the app and its wholesale partners the most money. Your best interest is not part of the equation. So let's put it all together. How do you calculate the real cost? You have to become a detective. Step 1. Find the true mid-market price. Don't trust the price you see on the app. Open a separate neutral source like TradingView or CoinMarketCap. Find the real-time price of the asset you want to trade. This is your baseline, your North Star. Step 2. Go back to your free app and go to the final confirmation screen for your trade, right before you hit buy. Look at the execution price they are offering you. Step 3. Compare. Subtract the true mid-market price from the execution price on your app. The difference is your real hidden fee. Now divide that fee by your total order cost and multiply by 100. That's your actual fee percentage. Let's do a final concrete example. You want to buy $1,000 worth of Solana. You check TradingView and the true mid-market price is $100 per SOL. That means your $1,000 should get you exactly 10 SOL. But on your zero-fee app, the buy price is $101. For your $1,000, you don't get 10 SOL. You get 9.9. You lost a tenth of a Solana. At a price of $100, that's a $10 hidden fee. Your zero-fee trade actually cost you 1%. A 1% fee might not sound like a disaster, but professional traders operate on fees of less than 0.1%. You are paying 10 times more than a pro, all while thinking you're paying nothing. And if you trade frequently, if you buy and sell throughout the year, a 1% cost on every single transaction is a catastrophic drag on your portfolio. It's the equivalent of running a marathon with weights strapped to your ankles. You might eventually finish, but you have no chance of winning. This is the truth of the zero-fee model. It's not free. It's just differently expensive. It's a masterpiece of psychological manipulation, built to make you feel smart for avoiding a $5 fee. While they quietly pick $100 out of your pocket through the spread, through slippage, and by selling your data to the highest bidder. They've weaponized financial complexity against the very people they claim to be empowering. We've now dissected the how. We've built the blueprint of the trap. But a blueprint is just a drawing. To really understand the danger, you need to see the trap in the wild. You need to know which platforms are setting it. Are they all the same? Is Robinhood's hidden fee the same as Webble's? Is PayPal's spread worse than Cash App's? In the next part, we're going to expose the who. We are going to name the names, compare the numbers, and show you exactly which of these free services is costing you the most money. You're going to want to see this. Alright, let's name the names. The platforms we're putting under the microscope are the ones that scream easy and free the loudest. The ones that are likely already on your phone. We're talking about Robinhood, PayPal, and Venmo. These are the titans of convenience, the masters of the simple interface. And we're going to pit them against our baseline from before, Cash App, to see who is quietly taking the biggest slice of your investment pie. To do this, we have to be scientific. This isn't about feelings, it's about cold, hard numbers. So here's how we ran the test. At the exact same second, we pulled up the price to buy 1 Bitcoin on all of these platforms. But that's only half the equation. To find the hidden spread, we need a benchmark. We need the real price. For that, we use the live institutional-grade price feeds from professional exchanges, the places where market makers and high-frequency traders battle it out. This price, the mid-market price, is as close to the true, unbiased cost of Bitcoin as a normal person can get. The difference between the buy price on your favorite app and that true mid-market price. That's the spread. That's their hidden fee. That's their profit. Let's start with the one that arguably started this whole commission-free revolution, Robinhood. Their mission was to democratize finance for all. A noble goal. They got millions of people into the stock market. And when they added crypto, it felt like a natural extension. No commissions. Just buy and sell. Sounds perfect. But when we ran our tests, the curtain was pulled back. At the moment we checked, the true market price of Bitcoin was, let's say for example, $50,000 flat. On Robinhood, the price to buy one Bitcoin was $50,275. That's a difference of $275. On a percentage basis, that's a spread of about 0.55%. Now you might hear that and think, 0.5%? That's nothing. But let's put it in context. Remember Cash App? Their spread was hovering around 1.75%. So, right off the bat, Robinhood is significantly better. It's not free, not by a long shot, but it's less expensive than Cash App. They make their money by routing your order to a third-party market maker, who gives them a better price than they give you, and Robinhood pockets the difference. It's a volume game. They're making a smaller amount on millions of trades. So, is Robinhood the villain of our story? Not exactly. They're more like the charming rogue who tells you dinner's on him, but you realize later he just ordered from the appetizer menu. It's not a full-blown ripoff, but it's definitely not the free meal he promised. So, if Robinhood isn't the worst, who is? Let's turn our attention to a name that's practically synonymous with online money: PayPal. For decades, PayPal has been the trusted way to send and receive cash. When they introduced crypto, it was a game-changer for mainstream adoption. Millions of people who would never have signed up for a dedicated crypto exchange suddenly had a Buy Bitcoin button right there in their account. The convenience is undeniable. But what's the price of that convenience? We ran the same test. True market price: $50,000. The price to buy one Bitcoin on PayPal? $51,250. Let that sink in. That is a $1,250 difference. That is a spread of 2.5%. 2.5%. That is nearly 5 times higher than Robinhood's spread. And it's significantly worse than Cash App's. For every $1,000 you invest in Bitcoin through PayPal, you are instantly losing $25 right off the top. You're paying a $25 fee for the privilege of clicking a button in an app you already use. PayPal is banking on the fact that you won't do the math. They are leveraging decades of trust to charge a convenience tax that is, frankly, astronomical in the world of finance. They have built a beautiful, simple on-ramp to crypto and placed a giant invisible toll booth right at the entrance. You might be thinking, okay, that's bad. It can't get worse than that, can it? Well, let's talk about PayPal's younger, hipper sibling, Venmo. Venmo, also owned by PayPal, is the king of social payments. Splitting dinner, paying your roommate for rent. It's effortless. And just like its parent company, it added a crypto button. It's fun, it's social, you can see what your friends are buying. Feels less like investing and more like a game. Surely the fees reflect that casual nature, right? Wrong. We ran the test. True market price: $50,000. The price to buy one Bitcoin on Venmo? $51,248. It's virtually identical to PayPal, a spread of just under 2.5%. It's the same playbook, just wrapped in a different user interface. They are targeting a younger generation, one that lives on their phone and values speed and simplicity above all else, and they are charging them a massive hidden fee for it. It's a family business, and the business is building a financial product that looks free, but functions like a high-interest credit card. So let's lay it all out. Let's put these zero-fee contenders on a leaderboard of shame, from the least expensive to the most egregious. In fourth place, the best of the worst, is Robinhood with a spread of around 0.55%. Not great, but manageable for small, infrequent trades. In third place is Cash App, our baseline, with a spread of roughly 1.75%. A huge jump from Robinhood. This is where it starts to get painful. And then we have the titans of transaction fees, the undisputed champions of the hidden spread. In a near tie for first place, the worst of the bunch are PayPal and Venmo, both clocking in at a staggering 2.5%. Let's make this real. Imagine you have $5,000 you want to invest in Bitcoin. You're excited. You're ready to get in the game. If you use Robinhood, their hidden spread immediately takes about $27.50 of your investment. If you use Cash App, that hidden fee jumps to $87.50. That stings. But if you use PayPal or Venmo, you instantly lose $125. Your $5,000 investment becomes $4,875 before it even has a chance to grow. $125 gone. Vanished into their revenue reports. All for the convenience of not having to download a new app. The truth is, these platforms are not designed for investors. They are designed for consumers. They've perfected the art of the impulse buy. They make purchasing a volatile, complex asset feel as trivial as ordering a pizza. And in that seamless, frictionless process, they hide a fee that no serious investor would ever dream of paying. They've taken a model from the world of currency exchange kiosks at the airport, you know, the ones that give you a terrible rate but are convenient, and applied it to the digital age. The spread is the silent killer of your crypto gains. It's the foundational cost that most people never even see. And for companies like PayPal and Venmo, it is a goldmine built on the ignorance of their user base. But here's the truly terrifying part. The spread is just the beginning. It's the most common hidden fee, but it is by no means the only one. There are other fees, other traps lurking just beneath the surface. Fees for selling. Fees for sending your crypto to another wallet, if they even let you do that. Fees that are so convoluted and buried in the terms of service that you'd need a law degree to understand them. You think a 2.5% spread is the only monster in this closet? That's just what you see when you first crack open the door. In the next part, we're going to swing that door wide open. We're going to expose the network fees, the withdrawal fees, and the service charges that can bleed you dry, long after you've paid that initial hidden spread. You're about to learn that the price you pay to get in is sometimes dwarfed by the price they charge you to get out. Let's talk about the Hotel California of crypto exchanges. You've made your trade, you've navigated the spread, and you see a nice profit sitting in your account. You feel good. You feel smart. Now you decide it's time to move that crypto to your own private wallet, where you and only you hold the keys. This is the moment of truth. This is where the zero-fee dream often dies a very expensive death. You go to the withdrawal screen, you paste in your wallet address, you type in the amount of, say, Bitcoin you want to move, and then you see it. A line item that makes your stomach drop. Withdrawal fee. And it's not a few cents. It might be $20, $30, even $50 worth of Bitcoin. Suddenly, a huge chunk of your profit, or worse, your initial capital, is about to be vaporized just for the right to access your own property. This is the first and most blatant post-trade fee. The fixed withdrawal fee. And it's a killer, especially for smaller investors. See, many of these platforms don't charge a percentage. They charge a flat amount of the crypto itself. For example, they might charge 0.0005 Bitcoin to withdraw. If Bitcoin is at $60,000, that's a $30 fee. If you're a whale moving a whole Bitcoin, that $30 fee is a rounding error. It's nothing. But what if you only bought $100 worth? That $30 fee is a 30% loss. You've just paid a 30% commission on a zero-fee platform. It's predatory. They're banking on the fact that small investors won't do the math until it's too late. They lure you in with zero fees on a $50 trade, knowing full well they're going to take $30 from you on the way out. And they have a brilliant excuse ready. When you complain, they'll say, "Oh, that's not our fee. That's the network fee. It's what it costs to process the transaction on the Bitcoin blockchain." And this is one of the most masterful deceptions in the industry. Yes, there is a network fee, often called a gas fee or a miner's fee, required to send any crypto transaction. But here's the secret. The fee the exchange charges you is almost never the actual network fee they pay. Think about it. These massive exchanges are processing thousands of withdrawals. They don't send them one by one. They batch them together into a single, highly efficient transaction. This means the actual network cost per user is incredibly low, often just pennies. But they don't pass those savings on to you. Instead, they'll look at the average network fee for a single inefficient transaction, maybe even pad it a little for volatility, and charge that inflated amount to every single person withdrawing. The difference between the tiny fee they actually pay and the massive fee they charge you? That's pure 100% profit. It's a hidden fee disguised as a public utility. They are using the complexity of the blockchain as a smokescreen to pick your pocket. But it gets worse. Some exchanges have moved to what they call dynamic withdrawal fees. This sounds fair, right? The fee changes with network congestion. When the network is busy, the fee is higher. When it's quiet, the fee is lower. The problem is you have no control and no transparency. They are the ones setting that dynamic rate. How do you know they aren't cranking it up during peak trading hours, not just to cover network costs, but to discourage you from leaving their platform when you need to move the most? It creates a system where you are penalized for wanting to get your assets out during a market crash or a massive pump, precisely the moments when speed is critical. And then we have the catch-all bucket of pure nonsense, the service charge or processing fee. This is my favorite. It's the financial equivalent of a shrug. It's a fee that exists for no other reason than because they can charge it. It's not the spread. It's not the network fee. It's an arbitrary tax for the privilege of using their withdrawal function. You'll find it buried in the terms of service, A single line item that can add another few percentage points to your cost basis. It's the junk fee of the crypto world, and it's everywhere. Now let's talk about the most insidious trap of all. It's not a fee you pay, but a rule that can lock your money up indefinitely. It's the minimum withdrawal amount. You've seen this, I guarantee it. You go to withdraw your crypto and a little message pops up. Minimum withdrawal amount is 0.001 Bitcoin. You look at your balance. You only have 0.0009. You can't withdraw. Your money is stuck. It is, for all intents and purposes, no longer your money. It belongs to the exchange. What are your options? Your only option to get that money out is to deposit more money or buy more Bitcoin on their platform, incurring more fees, just to meet the threshold to withdraw the funds you already owned. It is a hostage situation. They've locked your crypto in a digital jail, and the bail is to give them more money. This tactic disproportionately affects beginners who are just testing the waters with small amounts. They put in $50, decide crypto isn't for them, and then discover they can't get that $50 back because the minimum withdrawal is $100. So what happens? They just leave it there. It becomes dust. Forgotten. And when you multiply that by millions of users, these exchanges are sitting on a massive treasure chest of abandoned funds that they can use for their own liquidity. It's a multi-million-dollar business model built on trapping pocket change. And even if you have enough to withdraw, they have other ways to slow you down to maintain control. Ever tried to withdraw to a new wallet address and been hit with a 24-hour security hold? Or 48 hours? Or even a week? They sell this as a security feature. We're protecting you, in case a hacker added their own address. And while that can be a legitimate concern, it's also an incredibly convenient tool for the exchange. That 24 or 48-hour delay is a cooling-off period. It prevents you from acting impulsively. It stops you from rage-quitting their platform after a bad trade. It prevents you from quickly moving your assets to a competitor who has a better opportunity. In the world of crypto, 24 hours is an eternity. A market can collapse or double in that time. That security feature can be the difference between you securing profits and watching your portfolio burn to the ground. All while you're stuck in a mandatory timeout, unable to access your own funds. So you see, the zero-fee promise is just the front door. Once you're inside, the building is designed to keep you there. The exit signs are intentionally confusing. The hallways lead to dead ends. And every door you try to open has a different toll. The spread gets you in, but the withdrawal fees, the inflated network fees, the minimum withdrawal limits, and the time locks are the bars on the windows. They are all components of a system designed not just to facilitate your trades, but to control your capital. We've pulled back the curtain on the explicit fees they charge you after the trade, the ones they hide in plain sight. But what if the most expensive cost isn't a fee you can see on a receipt? What if the real trap is woven into the very fabric of the platform itself? We're not talking about fees anymore. We're talking about the architecture of loss. The system's designed to turn your trade against you to profit from your failure. We're about to enter the final and darkest level of this maze. The world of liquidations, cascading stop losses, and the platform mechanics that are engineered to take your money, even when you think you're winning. Imagine a casino where the roulette wheel has a hidden magnet. Most of the time it spins freely. But when the bets get big enough, when everyone has placed their chips on black, the casino operator has the option to press a button, subtly guiding the ball to red. The house doesn't just have an edge, it has an override switch. This is the world of crypto liquidations. It's not just about you making a bad trade. It's about the platform having a direct financial incentive to orchestrate your failure and possessing the tools to do it. Let's talk about leverage. It's the ultimate siren song of the crypto world. Turn your $1,000 into $10,000. Control $100,000 worth of Bitcoin with just a fraction of the cost. Zero-fee exchanges push these derivative products, these futures contracts, relentlessly. Why? Because this is where the real money is made. Not from fees, but from wreckage. When you use leverage, you're borrowing money from the exchange to amplify your position. If you go 10x long on Ethereum, you're betting that the price will go up. For every 1% it rises, you make 10% profit. Sounds amazing. But the reverse is also true. For every 1% it falls, you lose 10% of your initial margin, your collateral. If the price drops by just 10%, your initial investment is completely wiped out. Gone. This is a liquidation. But it's far more sinister than just a bad bet. The exchange isn't a passive observer in this. First, when you're liquidated, they don't just take your initial margin. They often charge a substantial, additional liquidation fee, for the trouble of closing your position. It's like being charged a penalty for losing. Second, and this is the critical part, remember how these exchanges act as their own market makers. In many cases, they are the counterparty to your trade. When you go long, they are effectively short. Your loss is their direct, unadulterated profit. So now the exchange has two powerful incentives to see your position liquidated. They collect a fee, and they cash in on the bet they made against you. The roulette operator suddenly has a very compelling reason to press that hidden button. So how do they press it? Let's meet a trader, we'll call him David. David isn't a newbie. He's been trading for a year. He understands the risks. He decides to take a 20x leveraged long position on a promising altcoin. He puts up $5,000 of his own money to control a $100,000 position. He knows a mere 5% drop will wipe him out. So he does the smart thing. He sets a stop-loss order at a 4% drop. This way, if the trade goes against him, his order will automatically sell, and he'll only lose $4,000, saving the last $1,000. He's protected, right? The market is choppy. The price of his coin is hovering. Then, in the span of a single second, something happens. On David's exchange, and only on his exchange, the price flashes down 5.1%. A long, terrifying red line appears on the chart, what traders call a scam wick, or a liquidation wick. Before David's stop-loss order at 4% can even be filled in the chaos, the exchange's liquidation engine, an automated program designed for this exact purpose, registers that the price has hit the 5% liquidation threshold. Instantly, David's entire position is seized. His $5,000 is gone. The exchange takes it all, plus a liquidation fee for their service. A moment later, the price snaps back up to where it was, as if nothing ever happened. On every other exchange, the price barely moved. But on David's platform, that single instantaneous flash crash was all it took. His stop-loss, his safety net, was useless. The system moved too fast. The wick was too precise. It shot past his stop-loss and hit his liquidation price in a blink. Was this just a moment of extreme localized volatility? A technical glitch? Or was it the liquidation engine, seeing a massive pool of leveraged long positions just like David's, briefly and artificially pushing the price down to the exact level needed to trigger a cascade of liquidations and reap millions in profit? The exchanges will always claim it's just market volatility. But when it happens over and over, when these surgical wicks appear out of nowhere and vaporize billions of dollars from retail traders, you have to ask, who benefits? The answer is always the house. This brings us to the even darker practice of stop-loss hunting. Exchanges have a complete order book. They know where every single trader has placed their stop-loss. They can see it all. Imagine a chart where there's a huge, obvious level of support, a price the asset has bounced off of multiple times. Thousands of traders, just like David, will place their stop-loss orders just below this level. It's the logical, textbook thing to do. But to the exchange's internal trading desk or their liquidation engine, this isn't a support level. It's a giant pool of money waiting to be collected. It's a treasure chest marked with a big red X. All they need to do is nudge the price down just for a moment to break that support level. The first stop-loss triggers, creating a sell order. This pushes the price down a tiny bit more, triggering the next stop-loss, which creates another sell order. It becomes a self-fulfilling prophecy, a cascade of forced selling that drives the price down dramatically, liquidating everyone who used leverage along the way. They aren't just waiting for you to lose, they're actively triggering the losses. This is the fundamental flaw of a centralized, zero-fee exchange that also offers high-leverage derivatives. It creates a perverse conflict of interest. The platform you trust with your money, the platform that provides you with the tools to trade, is simultaneously betting against you and acting as the referee with the power to liquidate you. It's like playing poker where the dealer can see your cards, and is also an active player at the table. How can you possibly win in the long run? You can't. The game is designed for you to be the liquidity. Your forced liquidation, your stop-loss, your panic sell, that's what provides the profit for the house. The zero-fee model isn't a gift. It's a distraction. Gets you in the door. It encourages you to trade more, to take more risks, to use more leverage. It makes you feel like you're saving money, while the real cost is hidden in the very architecture of the market itself. The real fee is your entire account balance. They've created a perfect feedback loop of profit. They lure you in with a user-friendly app and zero commissions. They tempt you with the promise of life-changing gains through leverage. They provide you with the tools like stop-losses that give you a false sense of security. And then their own internal systems can exploit the very positions and safety nets you've created, ensuring that when the volatility hits, whether it's natural or manufactured, the outcome is always the same: you get wiped out and they collect the pieces. This isn't just a flaw in the system. For many of these platforms, this is the system. It's their primary business model. The profits from liquidating a handful of over-leveraged traders in a single flash crash can be more than they'd make from an entire year of honest trading fees. The incentive is simply too powerful to ignore. They've built a slaughterhouse and convinced you it's a playground. But the maze has one final turn. What happens when this predatory model isn't just about individual traders? What happens when it begins to threaten the stability of the entire crypto ecosystem? And most importantly, is there any way out? The threat to the ecosystem is subtle, but it's monumental. It's a house of cards built on a foundation of retail order flow. Imagine if the majority of free trades in the United States are routed to just 2 or 3 massive market-making firms. These firms aren't just participants in the market anymore. They are the market for millions of people. Their algorithms, their latency, their financial health, it all becomes a single point of failure. What happens if one of these giants has a glitch? Or worse, what if one becomes insolvent? We saw with the collapse of firms like FTX and Alameda Research how interconnectedness can create a catastrophic contagion that wipes out billions in value overnight. The zero-fee model, by concentrating order flow into the hands of a few powerful players, creates the very same kind of systemic risk. It's a hidden vulnerability that most users never even think about. But the danger is deeper than just a potential collapse. It's about the erosion of the single most important asset in any financial system: trust. The core promise of cryptocurrency, especially Bitcoin, was a transparent, decentralized ledger, a system where the rules were open for all to see. The zero-fee model, powered by opaque backroom deals like payment for order flow, is a direct assault on that ethos. It reintroduces the very middlemen and conflicts of interest that crypto was designed to eliminate. When retail investors slowly realize that their free trades are being used to give high-frequency traders a split-second look into their intentions, they start to believe the game is rigged. And when they believe the game is rigged, they stop playing. This isn't just bad for the exchanges. It's devastating for the entire crypto space, which relies on a broad, active, and engaged user base for its liquidity, security, and legitimacy. The dream of democratizing finance dies, replaced by the same old Wall Street playbook, just dressed up in a shiny new digital wrapper. So is there any way out of this maze? The answer is complicated, and it's being fought in the halls of Washington, D.C. right now. The Securities and Exchange Commission, or SEC, under Chairman Gary Gensler, has taken a very hard look at this model, particularly payment for order flow in the stock market, which serves as the blueprint for crypto. The central debate is this: should this practice be banned entirely? Proponents of a ban argue that it's a fundamental conflict of interest. Exchanges have a duty to get their customers the best possible price for a trade, a concept known as best execution. But if an exchange is getting paid by a market maker for sending them your order, is their primary loyalty to you, the customer, or to the firm cutting them a check? A ban, they argue, would force exchanges to compete on a level playing field, based on the quality of their technology and the fairness of their prices, not on who can sell out their customers most effectively. It would restore a degree of transparency and force the real costs back into the open. On the other side, the zero-fee brokers and the market makers who profit from the system are fighting back with a powerful argument. A ban on PFOF would be the end of zero-commission trading. They claim that this is the very mechanism that allows them to offer their services for free, opening up the markets to millions of Americans who couldn't afford to trade when every transaction cost $10. They paint a picture where a ban would hurt the little guy, forcing small-time investors back to the sidelines. It's a brilliant piece of marketing, framing a debate about market structure as a fight for the common person. But it conveniently ignores the hidden costs we've spent this entire time uncovering: the wider spreads, the price slippage, the fact that free was never really free to begin with. While regulators battle it out, the most important question is, what can you do right now? How do you navigate this landscape and protect yourself? The way out isn't about finding one perfect, magical exchange. It's about changing your mindset. It's about becoming a deeply skeptical, educated consumer. First, you must learn to calculate the true cost of your trade. Stop looking at the commission fee line item that says 0. Instead, look at the spread. Before you execute a trade on a zero-fee platform, open up a real-time price aggregator like CoinMarketCap, CoinGecko, or a professional trading terminal. Compare the price you're being quoted to the actual live market price. Is your free exchange offering to sell you Bitcoin for $70,100 while the rest of the market is at $70,000? That $100 difference is your fee. It's right there in plain sight if you know where to look. Do this for every single trade. Make it a habit. You will be stunned at how quickly those free trades add up. Second, embrace the idea that paying a small transparent fee is almost always better than getting something for free. This is a fundamental shift. Look at professional-grade exchanges, the ones built for serious traders. They don't offer zero-fee trading. Instead, they offer a transparent fee schedule, often as low as 0.1% or 0.2% per trade. Let's do the math. Imagine you're buying one Bitcoin at that $70,000 price. On the zero-fee platform, the hidden spread costs you $100. On the professional platform, a 0.2% fee would be $140. In this case, the zero-fee option seems cheaper. But what if the spread is wider, say $200? Or what if the Pro exchange has a tiered fee structure where higher volume traders pay less? A 0.1% fee is only $70. Suddenly, paying that explicit fee saved you $30. The point is, with a transparent fee, you know exactly what you're paying. With a zero-fee model, the cost is a moving target, designed to be as large as the market maker can get away with. Third, consider the road less traveled: decentralized exchanges or DEXs. A DEX is a radical idea. It's a trading platform built directly on the blockchain, with no central company, no intermediary, and no CEO. You trade directly from your own self-custody wallet peer-to-peer. Because there's no central entity, there's no one to sell your order flow to. The problem of PFOF simply doesn't exist. This is, in many ways, the purest form of the crypto ethos. However, this path is not for beginners. Comes with its own set of challenges. You have to pay network fees known as gas, which can be expensive, especially on the Ethereum network. The user interface can be complex and intimidating. And most importantly, you are 100% responsible for your own security. There is no customer service number to call if you make a mistake. It's the Wild West, but it's also the frontier of a truly transparent financial system. Ultimately, the truth about zero-fee crypto exchanges in the US is that they are a masterclass in behavioral psychology. They tapped into our primal attraction to the word free and built billion-dollar empires by exploiting it. They created a system that feels like a simple, user-friendly game, while hiding a complex and predatory machine just beneath the surface. They sold us on the dream of financial democracy, while using our own trades to give sophisticated predators an edge. The goal isn't to say these platforms are pure evil, or that you should never use them. The goal is to arm you with the truth, to pull back the curtain so you can see the levers and gears whirring behind the slick interface. The way out of the maze is knowledge. It's understanding that when a service is free, you are not the customer. You are the product being sold. It's recognizing that in a world of complex finance, simplicity is often a disguise. And it's accepting that the only person who is truly responsible for protecting your capital is you. So the next time you see an ad promising free crypto trading, you won't see a gift. You'll see a question. You'll ask, what is the spread? Who is my counterparty? How are they really making their money? And by asking those questions, you cease to be a pawn in their game. You become a player. In the volatile, high-stakes world of cryptocurrency, the most valuable asset you can ever hold isn't Bitcoin, it isn't Ethereum, it isn't the next hot meme coin. It is the clarity and the wisdom to see the hidden price tag on free.